Hey, it's Steven from Trip of a Lifestyle, and today I want to talk about something that's getting pretty popular lately. They're called Series I savings bonds, also known as I bonds. So these are treasury bonds, they're an investment. When you buy them, you're basically lending money to the federal government, and they pay you back with interest. And that interest, the yield on these bonds, is linked to inflation. Now, if you've been following Trip of a Lifestyle for a while, you might think it's kind of strange to hear me talking about one specific type of investment, because I'm usually index funds, just set it and forget it, buy the whole market kind of investor. So let's take a look at why I bonds can sometimes be an abnormally good deal. So first of all, they can't be sold in the open market. They're actually only redeemable directly with the US Treasury. So when you want to get rid of them and get your money back, you have to redeem them directly with the government. You can't sell them on the secondary market. And they're also subject to some very rigid and somewhat predictable rules that are set up by the government. Because they follow rigid rules and they're not subject to free market forces of buying and selling, that means they're kind of not subject to the efficient market hypothesis. The idea that securities are priced efficiently based on available data, that one thing can't be that much better of a deal than another thing. If one thing is high reward, that means it's probably also high risk. If something else is low risk, it's probably low reward. That's the efficient market hypothesis. I bonds, because of their rigid government rules, are not subject to this idea, and that makes them a little bit exploitable. So here's the basic stuff you need to know about I bonds. First of all, they follow a 30-year term. And for the first year, they can't be redeemed at all. So if you put money into an I bond, you need to know it is absolutely locked up for 12 months. You can't even sell it to someone else. After a year and up to 5 years, you can redeem them anytime you want for their face value plus all the interest they've accrued. But you're going to owe a 3-month redemption penalty. So that's 3 months of interest that are going to be taken off the value of your bond. After 5 years, you can redeem them for their full face value plus the interest they've accrued with no penalty at all. Earlier, we said the yield, the interest rate on these bonds, is linked to inflation. So here's how that works. The interest rate is actually a composite rate that changes every 6 months. By composite, I mean it's made up of two things. First is a fixed rate, which is the same for the entire term of the bond. So when you buy the bond, the fixed rate might be 1%. That means you're guaranteed a 1% return for the entire 30-year term of the bond. The second piece is called the inflation rate. So that's based on recent CPI change. It's actually the annualized CPI change over a recent 6-month period. So in fact, you get the fixed rate plus the full value of whatever inflation has been recently. Basically, I bonds are a government program that was set up to help savers put their money somewhere where it would be immune to the effects of inflation, plus maybe earn a little tiny bit of interest on top of that, aka the fixed rate. Since inflation has historically averaged something like 3% per year, honestly, I bonds haven't been all that exciting in the past. To be honest with you, I don't even recommend I bonds as a long-term investment. I don't think they're that great. I think you'd be better off with a mix of stock market index funds and ordinary bond market index funds if you want to go that route. But occasionally inflation goes crazy and I bonds become temporarily a really good deal. So I'm going to try to show you how to identify those times. Now, obviously, since the yield on I bonds is linked to inflation, I bonds are a really good deal when inflation is high. Or more specifically, when inflation has been high recently. Remember, I bonds look back at recent inflation to determine the current interest rate. Another good indicator for I bonds is when TIPS yields are negative. TIPS are another type of treasury bond that protect against inflation, and when the real yield on TIPS are negative, that's a good indicator that I bonds are probably a better buy. Now, this third point is a tricky one. I bonds are an abnormally good buy when we know the interest rate on them will be high for the next 12 months. And that's only possible to know for sure in the months of April or October. Sound confusing? Welcome to a government program. Remember, we said earlier the inflation rate on I bonds resets every 6 months. Specifically, that new inflation rate is set every May based on the previous September through March CPI data, and then again in November every year based on the previous March through September CPI data. When you buy an I bond in April or October, you're buying into an interest rate that's about to reset. You're near the end of the cycle. But when you first buy an I bond, you're guaranteed the interest rate that you buy at for 6 months. So think about that for a second. If it's April and the interest rate on I bonds is really attractive, you can buy one and lock in your rate for 6 more months. But since the interest rate that it's about to renew to the next month is based on the previous 6 months of inflation data, you can already infer what the interest rate is going to be for the next 6 months. And when you go to renew 6 months later, it'll be October, and you'll be able to renew at a new interest rate that you already knew was going to be great in advance. This means you get 12 months, not 6, of guaranteed rates that you already know in advance at the time you purchase the bond. And remember, you can't redeem an I bond for 12 months, so it's pretty important to know the interest rate you're going to get for a full 12 months. The only time you can do this is in April or October. So let's use the time I'm recording this video, April 2022, as an example. Right now, the inflation rate on I bonds is 7.1%, and the fixed rate is actually 0%. So if you buy an I bond today, you're guaranteed to get a 7.1% annualized return for the next 6 months. Now, the rate's about to reset in May, and we already know that May's new rate will be 9.6%, because that was the annualized change in CPI from September 2021 to March 2022. May's rate will be the official rate for I bonds for another 6 months. So when our rate that we buy in April comes for renewal 6 months later, it'll be renewing at the 9.6% rate for 6 more months. If we buy I bonds today, we get 7.1% for the next 6 months, and then our rate updates to the 9.6% in October, just before the next change happens. So is that a good deal? Are I bonds a great buy right now in April 2022? Well, for the last year, price inflation has been about 8.5%. That's high inflation. That's one of our criteria for I bonds being a good buy. 5-year tips are yielding negative 0.45% per year right now. And most importantly, we know the yield for the next 12 months. It'll be 7.1% for 6 months and then 9.6% for 6 more months after that. Those are historically high yields on I bonds, and they are way better yields than you can get on any other risk-free asset right now in the market. So I would say, yeah, I bonds are a pretty good buy right now if you're looking for something low risk. So how long do you have to hold the I bonds? Well, here's your worst case scenario. If you bought some I bonds today, April 2022, you'd collect 7.1% interest for 6 months and then 9.6% for another 6 months. If the new rate after that was 0%, that's your worst case scenario because the rate can never go below 0, then you would want to probably cash out. If you cash out immediately after the 12 months are up, you'll pay a 3-month interest penalty, and the net rate that you'll have gotten over the full 12-month period after paying the penalty is about 6%. 6% is still better than any other risk-free instrument available in the market today. So your worst case scenario buying right now is a positive 6% nominal return on a 12-month investment that's guaranteed. Now, there are some restrictions on I bonds that don't apply to open market securities, and there's a good reason for that, because I bonds are exploitable. The government knows about these loopholes that you can buy them only at specific times when they're better than everything else on the market, so they put some restrictions on them. For one thing, you can only buy $10,000 per year per Social Security number or EIN, or technically $15K if you're willing to jump through some hoops on your tax return. And secondly, you can only buy these things directly from the US Treasury. You usually do that via treasurydirect.gov. You can't just buy them in your brokerage account, so that makes them a little bit inconvenient. So should you buy I bonds? Do the math in either April or October and see what the guaranteed worst case scenario result will be for the next 12 months. If you like it, pick some up. But realize that I bonds are never going to really make you rich. They're just keeping pace with inflation, and you can only use them up to $10,000 per year per Social Security number. So that really limits the gains you can make. With that said, they can sometimes be the best low-risk investment available. Like for example, in April 2022, I think they are. So if you're looking for something low risk, then consider their merits every April and October and ask yourself these same questions. If you find our all free content to be useful, please make sure you hit the like and subscribe button, and check out our blog at tripofalifestyle.com. There's a lot more free content there.